Hey, this is Sasha. Thanks for joining me here for another episode on Let's Talk Stocks. Today I'm going to share with you my 4 key tips to trading and investing in IPOs. Stay tuned and listen up. All right, so a lot of people are interested in trading IPOs. For example, you want a nice hot stock, it's coming in, and then eventually it explodes a little bit later down the road. A lot of new companies come in because there's a lot of great hype, and then you hope to get it near the bottom. Now, recently, over the last decade, those IPOs have been coming out a lot later than normally they do, because now you have a lot of venture capitalists, there's a lot of very rich people that will invest in these companies way early on, and you're actually now getting the IPOs or the initial public offering much later than you normally would, let's say 10, 15 years ago, because now there's new ways to raise money, from crowdsourcing to private investors, angel investors, all kinds of different ways. But there's still a good opportunity if you're investing in the right stocks at the right time and you allow them to run. You can make some great investment decisions, allowing that stock to move into the future. So take, for example, here, if you invested in Facebook, even if it was early on in the IPO, which was not as early as way back in 2010 or earlier, but even then, even if you invested in 2012, 2013, 2014, you're still way up at higher prices. And that's what you ultimately hope to do when it comes investing to these other companies. Now, I want to share with you, there's a lot of different IPOs that have come out over the recent little bit of time. For example, like DocuSign right here has come out. You also have things like Uber. You have, BJ's as well for BJ Wholesales. You have Dropbox and Spotify Technology and Snap as well. So all these companies do make a debut, and they've been on the market now for a little bit of time, but not all of them are performing quite well. So if you take a look here at Snap right here, as we check it out, you can see that this company initially, hey, we opened up at this price, and now, in fact, at the current market price, it is lower. Okay, so definitely not kind of the best things. DocuSign, if you look kind of a 5-year, it's kind of very near or even where it was. So let's check this out a little bit better on the chart right here. A lot easier to see. So you can see this one right here starting to come in and possibly do a breakout. But you can see at IPO time, a little bit lower here, digesting sideways. So it's a lot higher than where it was, but not anything amazing, because it ran up if you got it initially, and now it's almost back break even over the last 2 years. So anyway, checking out here, BJ's, let's look at kind of a 5-year. Well, you could see again, this one, here it was, and you can see it's almost back where it was. So what are kind of the rules or thought processes to trading or investing in these stocks? So I'll give you my thoughts. And rule number 1 here is to be patient. You got to be patient and allow these things to kind of set up. See, what a lot of people do is they go ahead and they get into these stocks where they want to get in it real quick. They don't wait for the big money to step in. They don't wait for a nice breakout. So look at anything like Facebook here, okay? You have to be patient in this company to allow that stock to digest for almost a year to 2 years before that stock actually made its way. If you look at even AMD recently, that stock over the last few years has been dormant, and now it's continued. Now, this isn't an IPO, obviously, but check out any other company that's kind of new. It takes time for these things to digest. So look at Snap. It's still not moving and breaking out past that IPO. If you look at Alibaba, which was an IPO, here's Baba, and we'll back it up. You can see, look, even this one started out at at about $80, $90 a share, and then it pulled back a bit. So for a little bit of time, it went sideways. And eventually you had its nice movement and finally breaking out just a couple years later. So you got to be patient to allow those things to set up. All right, so looking at number 2, let's check it out. Rule number 2 is to know the risks and capital investments. See, what happens is a lot of people, they get into the stock, they're not sure of how much capital to put in, but they overdo it. They put too much cash into an IPO because they think, hey, this is my investment. But remember, an IPO is a little more speculative. It's a little more new. It's not like a Microsoft. It's not like something that's been around for a while. So if you look at Microsoft, it's got a proven history, and it goes back many, many years to right now, 1987 or so. And anything like even a Procter & Gamble, many, many years in the past that has historical data. But if you're doing anything like a Snap, well, you don't have a ton of data. You know, if you're doing anything like a BJ's Whole Foods or Wholesale Club, again, doesn't have a ton of past historical data. So you need to really just know the risks and the capital invested. So for you, if you're going and let's just say, here's your portfolio allocation, well, you don't want to invest all of that. You might invest just a little part of that portfolio or even less into these IPOs. Because that way you still have the stability of your own financial portfolio invested, but you got some exposure to the IPOs. And that's the smarter approach that many people don't really think about. All right, let's check out rule number, let's say 3. Rule number 3 is to take profits into strength, okay? A lot of people don't take the profits into strength. All they do is they go ahead and hold on to these stocks. They think, hey, it's gonna be a great stock. I'm gonna hold on to it forever. But hey, I wanna show you something. Here is Spotify, okay? It's opened up, continues, and it's still lower. Here is Sirius XM. Okay, look at this stock. We had our IPO right here. Stock moved up, looked good, sold off, and now it continues to be in the gutter for almost 20 years. So think about that. Do you want to be stuck in a stock for 20 years? And initially it might have looked good. It was good for a few years, you know, when the big hype was 1995 to about 2000, so about 5 years. Then after a while, things just sold off and just continued to tumble. So anyways, my point being is that no matter what company, even GoPro, sometimes it has its days, and if they don't evolve because they're so big, it's tough to turn a big ship around. And here, this stock, it's now multiple years in the gutter. Will it continue to break out? Is it speculative play? No, probably not. Chances are it won't. Sometimes they do, but it's very, very difficult. So take profits into strength, and that is my rule number 3, because if you don't take profits in the strength, the market will take them for you. And what I mean by that is, let's say you got into the stock over here on GoPro. Well, it goes up quite a bit, or man, this thing's flying. Take a little off. Take a half off, a quarter off, a third. Goes up a little more, another half, another quarter, another third, okay? And once it finally, you know, starts pulling back, maybe you're out. Maybe that was it. That was the investment. It was for a little bit. These companies don't always stick around for a long period of time. All right, let me go to rule number 4 for you, and that is, if we check it out, more IPOs will follow. So you got to remember, hey, this isn't the end. This isn't the last one. There will be more IPOs. Just like here, we've got BJ's that just came out. We've got Dropbox. We've got Spotify. We've got Snap and Uber. There will be more companies. So if you're looking at the reports and you're looking at, let's say, hey, well, what about Dropbox, right? Hey, okay, well, here's an IPO. Here's what it's doing. Here's what's happening. And maybe it's not the one to invest. The chart doesn't look good. Doesn't look sustainable right now, but things could turn around. It's fairly new. But just like you had, well, Twitter initially, okay, right? Still kind of there, not really profitable. You could see it's multiple years. It's just same where it is. But you do have some of those success stories like a Facebook or many other companies here. You can see Facebook doing well. Tesla, if you got into it, you know, here's the IPO, took a couple years and then it exploded, right? So again, very, very well done and very well run and was successful for many people if done accordingly. But remember, if you miss it, there will be more. There will be more IPOs. They keep coming. There's Tesla came out in 2010 and you got Snap now that came out in 2017. So more IPOs will come. There's Etsy that also came out. When was this? This was in 2015. You got Shopify that came out. When did Shopify come out? Fairly newer stock. It's not loading right now. How about Wix? Maybe a slight delay. All right, so here we go. Wix, came out in 2013, and Shopify came out in 2015. So you can see these things do eventually, here, sideways action, and then you get that explosion effect that may happen. And that's what you're looking for. But you got to understand these rules and these concepts if you want to make it in the IPOs. Otherwise, hey, if you're thinking I'll just hold it, invest it forever, some of those things, as you saw, don't pan out and don't pay well. All right, thank you so much for joining me. If you're interested in more videos like this one, be sure to subscribe to the YouTube channel, or of course, join me on my newsletter list where I share other big news, announcements, courses, books, and other great freebies. Thanks again, and I'll see you next time.